Greetings and happy Sunday night for those who are on the East Coast. I am joined by Marc Chandler out of Connecticut, myself, Samantha LaDuc from Massachusetts, and Craig Shapiro from Florida. We are here to talk a little bit about the dollar and what's going on with the war in Ukraine and its impact on the dollar. I want to thank both gentlemen as I have put this together very quickly because of just the constant cross currents that are going on in the past on the global stage the past few days, and it's war in Europe. And then yesterday when I had this idea, swift action was foreboding but not yet carried out. It has since come through in large part, and we'll talk about what that means. And again, I am very privileged to be joined by Marc Chandler, Chief Market Strategist, BannockBurn Global FX. Marc wrote a book, which I've read years ago, and have stayed in contact because he's absolutely a currency expert and gives great perspective. He's been doing the road trip this morning virtually with interviews all over. And I think he just finished one from CNBC Asia. So very grateful that he's kind of capping off his Sunday with us. Craig Shapiro, client for years, and then recently joined up with me on my LaDucTradingEDGE product, which is an institutional offering, which is very much macro focused. And I am Samantha LaDuc, founder of LaDucTrading.com and LaDucTradingEDGE.com. I want to thank you, gentlemen, very much for taking your time on this Sunday evening. It's usually family time. It's very rare for me to be doing one of these so on a Sunday night, but the stage is set. We have some very impactful events going on, and I wanted to get your respective views on them. Marc, since you've been doing the capturing of your views on national media, international media, why don't you kick it off?
Sure. So I think I take for granted that we've all been following the news, but I try to put the two elements in perspective. And the part that mostly affects the financial markets is a chokehold. The U.S., Western Europe, our allies in Asia are not going to fight the Russian forces with our personnel, with ourselves, with our children. But we are putting a chokehold on Russia through the financial channels. And these financial channels, I'd say, are fewfold. One, as we saw before the weekend, the sanctioning of the top banks in Russia. And that sanctioning is like blacklisting them, like you can't trade with them. They cannot trade in the US with parties that have offices in the US, because those can be sanctioned as well. So the first is sanctioning Russian banks. Over the weekend, there was an agreement to kick off from SWIFT many of the Russian banks. It's not clear how many. That's going to be worked out in the next day or so. It's a coordinated effort, of course, because as you know, SWIFT is not a payment system, but it's a messaging system. It's how banks really communicate with each other, probably the primary way banks communicate with each other. So knocking Russia off of this also sort of like cuts their cable lines, if you will, takes away their cell phone to some extent. And the third thing that I think is important is they've gone after the central bank itself. Your Europeans say that their transactions with the central bank are banned. So this is basically how the central bank has access to nearly $1 trillion through their own reserves and through their sovereign wealth fund. So for me, the big takeaway from what happened over the weekend on financial grounds is that the sanctions that we saw last week, that on Friday there was a sigh of relief that there seemed to be like a return, like risk appetites came back. Remember what an incredible recovery in the stock market too that took place on Thursday, followed through on Friday, where S&P and the NASDAQ closed higher on the week. And so we come back here today, and I think that's risk off immediately. But you already can see signs of that risk off stabilizing. But the big point is that the full pressure on Russia, a chokehold, if you will, on Russia is going to see. We've already seen the downgrades at the end of last week on Russian debt. We're going to see the ruble, which is, your guess is as good as mine where the ruble is going to open, partly because the black market is showing something like 100% devaluation. Basically, the currency has been cut in half. That's what it looks like, but we're not sure. But these Russian bonds were also hit last week. this is a horrible financial hit to Russia. On the military side, it's also very important to recognize a couple of big things that have happened. And probably the most important, and it affects the financial markets it may down the road, is essentially that Germany had up till now been opposing their own rules, prevent them from sending weapons into a war zone. They got rid of that. They jettisoned that stance this weekend and sending lots of weapons to Ukraine, as well as something that U.S. presidents for over a decade have been complaining about. They're stepping up their defense spending. And they say that the new government in Germany says they will not only spend 100 billion euros or commit 100 billion euros to modernize the military this year, but they're going to boost the defense spending to the 2% that NATO has long required or long asked for. And so there's other countries that are breaking their sort of typical neutrality. The Swiss are talking about freezing Russian assets.
That was a surprise.
That was a surprise. Sweden is also, Sweden plays as neutral on military, but they're also sending weapons to Ukraine. And the EU itself is not just sending these defensive weapons, but they've also offered jet fighter planes. So it's almost like, I'd say, a new arsenal for democracy has been created over the weekend, alongside this financial chokehold on Russia. But of course, with the Russian forces being put on higher nuclear alert, you can appreciate why there'd be a risk off immediately before the Asian markets really opened. And that's why I was saying that so far a big down move, but things are still look to be stabilizing. Give you an example: the euro got down to 111.20 or so, almost last week's lows, and now it's trading 111.85 or something. So it's it's a little bit more than a half a cent bounce. And I think you can see this in some of the other markets too that have begun stabilizing. So big knee-jerk reaction. The world's coming to an end, and then people like markets, I guess more rational heads prevail. People looking through this, seeing that the other big effect, the financial effect, and then I'll leave it with you, is the last week we saw this, and I suspect it'll continue this week, and that is the market has decided that there's much less of a chance that the Federal Reserve or the Bank of England lift rates by 50 basis points when they meet next month. The Bank of Canada meets later this week. The market, it was at Friday at least, the market was still pricing in about a 75% chance that the Bank of Canada would raise rates by 50 basis points. But they've really scaled back the aggressiveness that had been priced in to the US and the UK, the overnight index swaps, which are like an institutional market that we look at to really see what the market is pricing in.
Well, I'm just pulling up some futures as far as indices, and they are not down as much as many would expect, but there is often an invisible hand that comes in and makes sure that we're not completely trashed. But VIX is obviously very elevated. Crude, which is expected, definitely the markets are down, but not as much as what people really expected. On the currency front, dollar definitely has a short-term bid anyway. And as you mentioned, the euro is down, but not plunging. Basically, we have a lot of chop in relative terms to what many are expecting because of what's happened in Russia's stock market. I would note that about 2 hours ago, they kind of declared that no selling allowed. So those equities that are sitting over there in the Russian stock market, those who want to get out will have a really tough time. But I do want to bring up the outperformance on Thursday and Friday. I mentioned this for clients because, as you know, I'm an options trader and I follow market structure very, very closely. I don't think it was bullish war or the Fed. Oftentimes, sell on the threat of invasion, buy on the news. I don't think that was it. I don't think it was even the Fed potentially not raising because of this invasion. I think it was just a good old fashioned loads of put sellers that created a heck of a squeeze. And basically the dealers had to buy the deltas in order to maintain the book, keep it neutral. And this is a chart by Spot Gamma that very much displayed that outsized market structure. So I don't think it was really a condition of the narrative The macro, I think very much that Thursday, Friday bounce was in fact a short covering rally. So I just want to kind of put that out there on the trading side, because as much as we are talking macro, we trade actively. Craig is a hedge fund manager, and he's also our macro advisor for institutional clients, but we're actively trying to, position on across different assets and different timeframes. And that was particularly a time where folks were very, very nervous, because we obviously took out the January 24th lows. And I opened up my live trading room, in fact, in order to kind of navigate, saying this looks like a very solid short-term bounce, but still stay swing short. All of my indicators said it's not safe yet, not connecting the narrative of the macro that we would have this outsized currency volatility and, escalation in the invasion. And, to the credit of the Ukrainian people and the troops and the volunteers that are fighting over there, it's heartwarming to see how the world is definitely rallying in support. That's all, that's very inspiring. But the overarching plan of Putin to kind of carry through this initiative sooner rather than later is definitely, I think, a lot faster than folks expected. So a lot discounted the invasion altogether. They didn't, even heed the warnings. And then when it came very, very quickly, and now it's escalating. So everything revolves around the dollar so much, especially I want to kind of transition to Craig's thesis also about the threat to its world standing as reserve currency. So I would like to kind of bring that kind of backdrop of, we have a trading environment, short term, longer term, we want to address, and then also the perceived value of the dollar and where it's going from here based on world changing events. So Mark, any comments on that in relation to kind of what news you have kind of at the context of the news that you have received? Has it changed any of your opinion on the strength of the dollar?
Well, so in the big picture, I thought that the dollar was going to weaken, especially in the second half of this year, because I thought that the things that are taking place. I think that for me, it's the idea that the Fed has waited too long to raise rates, to tighten policy, and because they waited too long, they, like fiscal policy, are going to become pro-cyclical. That is, as the economy slows down, the Federal Reserve is raising interest rates, and the federal government is withdrawing the fiscal support we saw last year. Mm-hmm. And the other thing I would point out is that many of us experience oil. We think of it as inflation, but the way it really works from a macro perspective, I'd suggest, is it really is like a tax, not only on energy, like filling a car with gas or heating your house, but it's also our food is highly oil intensive. Mm-hmm. Now, I'm not just talking about the tractors and the trucks delivering it. I'm talking about the fertilizer, the pesticide as well. And this is, and when you have higher like agricultural goods prices, you also get higher meat prices. So I do think that what's happening in Russia and Ukraine is going to boost inflation, but because it's also boosting oil, though we're not, I'm watching that April West Texas contract, and we're not at last week's highs. We got over $100 last week. We're holding below that, and sort of the knee-jerk reaction here early in the new week. But so I'm concerned that in the short run, so on like a tactical medium-term view, that the dollar is going to strengthen a bit more here as we get ready for the first Fed rate hike, and then weaken more in the second half of the year. And I suspect the twin deficit problem comes back to haunt it. But in a bigger sense, and perhaps this is really what you want to more talk about tonight, is what does this mean for the dollar in general, and the dollar's role in the world economy? And I suspect that at the end of the day, it's possible that Russia develops a different payment system from the SWIFT system, and that China helps it, and it could create this a coordinated effort to come up with an alternative. Mm-hmm. I don't really see that happening. You don't read this in the U.S. press very much, but Chinese banks typically adhere to U.S. sanction rules. North Korea, Venezuela, even sanctioning Hong Kong officials, because Chinese banks don't want to be sanctioned themselves, excluded from the dollar settlements. And this is a really important part of the plumbing that I think stands behind the dollar and stands behind its role in the world economy. Countries, even like China, they don't want to be kicked off of the dollar system. They're not quitting the dollar. Russia didn't quit the dollar system. It was fired. That's why it took its reserves and moved from dollars to gold because of all the sanctions. And so my own guess out of all this is that the dollar's role probably gets stronger. We're talking about conflict in Europe. That peace dividend, which really rewarded risk takers. I think when push comes to shove, what do people do? They buy dollars. Dollar is still the safe haven in the world.
They're
Even today,
expected
right?
they're going to want to buy them tomorrow because the ruble, obviously, there's a bit of a run on the Russian banks and that conversion to dollars. But not sure if that shortage of dollars is going to keep the dollar elevated. We have talked about this, Craig. What's your theme in regards to the dollar's kind of future trajectory?
Yeah. I mean, my thought here is that there's more to Russia's desire to move on the Ukraine than just, a military target. I think there is a larger trend here that Putin has been talking about for years regarding replacing the dollar as the world's reserve currency, shifting into a multilateral currency system, using more RMB, euros, yen, gold, et cetera. And so they've, in addition to Mark's comment about being thrown off the dollar system from a sanctions perspective, Russia has actively, been seeking out, transacting away from the dollar. So I think, amongst their FX reserves right now, gold is number one, RMB is number two, and euros. Yeah, I mean, so they've moved massively in that direction. And so my supposition is that China also is moving in this direction. And this is a thesis that, someone like Luke Groman has really been talking a lot about, and others, like him, about the Chinese government, the Chinese PBOC's ability to basically now print RMB to buy oil, and how, they are able to print their own currency, just like the US has historically printed its currency in order to buy commodities. Now China is able to do it. This is something that's been going on since, basically the early part of 2018. And so if you look at, to Mark's comments about the Fed and controlling inflation, and where people want to put their money, the RMB versus the dollar is as strong as it's been since basically the early part of 2018. It's been the best performing big currency, over the last, several months, and even through this risk off period, the RMB keeps rallying against the dollar. So the question is why?
I think. Second, though. Let me just ask you here, because we say the RMB continue to rally. Take a guess at how much it's up this year. But you're right; it is at multi-year highs. It's up less than a percentage point. So it's moving, but less than 1%. I'll give you I think people are moving out of China because the interest rate differential has narrowed so much, moving out of the bonds. And you know what they like? Brazil. Brazil's currency is up 7% this year. China, less than 1%.
Yeah. Yeah, no, look, I'm just, from a developed market perspective, are they coming to like that's more indicative to me that they're not coming into dollars, right? They're not moving into the US dollar. And so my thought is that Putin has thought, has scenario analyzed, has game theorized these moves, for months, years in advance. And so I think that together, the two of them have coordinated basically an attack here on the dollar, where they will continue now to price more commodities in RMB away from the dollar and help chip away at the dollar's hegemony. And I think you're seeing that. I think you're seeing a Fed. I think you're seeing a central bank in the US that is not fighting inflation properly. And I think you're seeing a central bank in China that does fight inflation properly. And so, and that's part of it. You look at the spread in CPI between the US and China, since China introduced this RMB for oil current contract in the early part of 2018, the correlation of that ratio of the spread between inflation with the dollar RMB is pretty, moves basically in lockstep, suggesting that the currencies now really are moving more on a terms of trade type situation, the US being a current deficit country, China being a massively current account surplus country. And so currencies are moving more in that direction. And so I don't know, part of me, it's big picture, it's thinking out loud and saying Russia has alternatives here and has thought about them and is not coming into this situation blind. And I think too many people are focused on the negatives that are impacting the Russian economy, which are clear, and what is going to happen here with the ruble, but that they have tools at their discretion also to inflict pain on the rest of the world. And if the strategy for Putin is one of, basically mutually assured destruction, for lack of a better word, if Russia's economy is going to go down, the rest of the world's economy is going to go down too, because oil and energy prices are going to continue to be elevated. He's going to transact away from dollars and euros into gold, into RMB, sending more energy flows to Asia, and puts Europe and the US in a very precarious situation. So I think there's more to this story than just Russia's attacking Ukraine for territorial purposes. I think there's a larger game at play here to chip away at the dollar, and I think they see a US as a weakened hegemon. I mean, you have the Biden administration with polling data basically at the lows. You have inflation data in the US running away. And so Putin kind of saw an opportunity here with the US that's in retreat militarily, which is, has pulled out of Afghanistan, has moved back from its aggressive, or aggressive is a bad word, but from its stage, from its presence in the international arena, and kind of saw this as an opportunity here Putin saw this as an opportunity here to kind of move more aggressively to accelerate this plan to, chip away at the dollar and chip away at the US's power. So, and I think from China's perspective, given that they want to potentially move in Taiwan and do other things there, we can talk about that later, but I think they see this is kind of a match here where China can buy oil and energy from Russia, transact in RMB, settle in gold if needed, sell Russia goods, and we're moving into that direction. And hopefully along the way they're picking up other nations and some of them rogue, some of them not. But if you think about the Belt Road Initiative and all the countries that are kind of tied in with China, they're creating this multilateral world, where they are more in the foreground, dictating kind of the trajectory of global policy. So that's kind of something that I'm exploring and thinking about. And when I see the price action, and when I see how gold's doing, I see how oil's trading, and I see how the RMB is trading, and I think about SWIFT, and I think about freezing Russia's central bank reserves overseas, trying to think about what are the likely paths here that the Russian government can take, in order to instill pain on the West.
And I'm showing a chart right now of the 30-year US Treasury bond price, and this is actually since the 1980s. And I bring this up because commodity prices are expected to skyrocket, obviously, removing quite a bit of supply from the market, and an energy crisis in full swing already. And we already have inflation from supply chain stress and the rest. So I'm looking at commodity prices, obviously, spiking higher. Do I have a new share shown? Ew, I forgot to. All right. So that means, for me anyway, rates move higher and bonds move lower, and that's the issue. We could have a very potential continuation of, I'm a bond bear, but a bond break that actually breaks markets as well. So equity and bond underperformance for the year was already in play, since the first of the year, and now we have this situation with even higher commodity prices about to, in some cases, skyrocket. This is definitely going to be an issue for the bond market. Any comments on that?
Well, I'm watching this as well, the bond market, but what I'm watching is that the yield curve. So I take your long-term yield and a short-term yield, like the 2-year, and I'm looking at big curve flattening. And this is telling me that the market also expects the Fed to get inflation under control, and the cost of getting it under control is driving the U.S. economy probably into recession. So I'm looking at the, even today, right? You've got the U.S., imagine what's happening. You say we've got 7.5% CPI, our 2-year yield, 1.49%. Our 2-year yield is is 600 basis points almost negative real rate. And so I don't think this would happen if a central bank lost credibility. I don't think it would happen if the market was really worried about inflation or really worried about aggressive Fed tightening. And for me, I watch the financial markets maybe more than commodities, and I'll tell you why. The foreign exchange market, this is why I've spent a career with it, is daily turnover is about $6.5 trillion. That means in 1 week, there's enough foreign exchange turnover to cover world trade for a year. So when I look at what drives the currency markets on a day-to-day basis or a week-to-week basis, I'm often watching what's driving capital flows. And I just think that the U.S. market, the depth and breadth of the U.S. market is really the best is the biggest in the world. And there is money going into Chinese equities again. But I think on balance, it's these capital flows that stand behind the dollar and stands behind, like, even when you think about Chinese bonds, how small of a market that is. Partly because the federal government, their central government doesn't have a lot of bonds. Their bond market is like the European bond market, which is much more like the US muni market. A lot of small issuers or modest issuers, all they have the different rules of supplies and how you have to deal with it. And so the treasury market is just the biggest uniform market in the world. And to me, that's what stands behind the dollar. And so for me, it's not just that the long end yields had risen, coming back off now, but how low they've stayed. And this is what the market's telling us, I think. It's not just that the Fed's going to tighten. I think everybody and their mother knows that. The issue really becomes, what's the terminal rate for Fed funds? Well, the terminal rate, well, that is the peak of Fed funds. Will that even get to neutral? The Federal Reserve says neutral is about 2.25 to 2.5. The market's saying it's not even sure it's going to get to neutral in this cycle.
Yeah, I mean, my thought here is the markets are thinking about this Fed tightening cycle and looking at the historical deflationary trends that stem from demographics, technology, the debt situation, and saying, these are with us forever, and we will continuously, be in a deflationary cycle. So, there's no sense in selling long bonds. I think in this world where after COVID showed the weakness in the supply chain globally, and now after this Russia-Ukraine situation has kind of exacerbated energy shortages, and if I'm correct, and Russia and China are forging more aggressively strong ties, that these supply chain issues are basically being weaponized by both China and Russia to create havoc for us, to improve their own domestic situations. And so the US and its allies are going to have to rebuild their own domestic supply chains and bring supply chains closer to home.
That'll take time, though.
But the path to doing that is inflationary. This is a major offset. This is a major offset to the pre-COVID deflationary trends of demographics and technology. And I think we're going to have more export restrictions. We're going to have more nationalization of resources. We're going to have more countries procuring energy and agriculture goods at insensitive prices. I mean, the governments that have, falling polling ratings are price insensitive buyers of commodities. They just need to keep the lights on. They need to keep the public fed. So we are going to have an environment where inflation in the supply chain is stickier for longer. And yes, we'll go from 7.5% on CPI down, somewhere to because of base effects and, just because of the math of inflation. But the Fed's looking for a 3% PCE at the end of the year, or potentially lower. I suspect we don't get there. I think we're going to be stuck in a 4 or 5+% inflation regime, and that's a regime where the Fed has a very irresponsible monetary policy. And so I think there's either two paths that they could take. They can either tighten, get on board, tighten very aggressively, and cause the recession or exacerbate the recession of the growth slowdown that you're looking for, or they can fail to do that because, let's say, they're concerned about rates moving too high because of government financing, and that will destroy the dollar. So they're increasingly getting put into a tough place here, where tightening leads to a recession that brings down tax receipts and makes it difficult for the government to pay its bills, or do nothing, run inflation hot, and run the risk that the dollar really starts to spiral in a much more aggressive direction downward. And now that there is an alternative system that's being created, and I think the Russia-China system is well further along than people realize. And look, I'm not saying that that's something that the investors in the West are going to do, but when you hear India say they're happy to set up a rupee-based system to buy oil from Russia, and you think about Pakistan, and you think about other BRICS countries and the like, we're starting to create a world of multi-polarity, for lack of a better word, and that pressure on the dollar as it declines in percentage of transactions on a global basis, particularly in commodities, creates that pressure. And so the US starts to trade for like an emerging market, where its trade balances, its deficits are a problem. Its lack of getting inflation under control is a problem. And so that's an environment that, we don't have that. Maybe we don't have that today, but as we turn the page into the second half of this year into next year, if that's the environment we're talking about, it has massive implications for risk taking, where we want to put capital, growth versus value, commodities, et cetera. So that's the environment that I'm thinking increasingly starts to play out through this. And I think these trends from this invasion are accelerating that transition.
Yeah, I just think for me, I mean, I tell you that a lot of people do think and talk about Russia and China working together closely, and people talk about that big multi-year energy pact that they were just agreed on. But what struck me was, what currency did they settle it in? They didn't settle it in Russian ruble. They didn't settle it in RMB. They settled it in euros.
Yeah.
And the euro's share of global reserves today is smaller than the sum of its parts. Remember, before the euro was the Deutschmark, the French franc, Belgian franc. Well, you add up those currencies' share of world reserves on one hand, and you have the euro's share on the other hand. Those legacy currencies had a bigger share of reserves than the euro does today. And I sort of think that US media sort of exaggerates this Chinese-Russian alliance. Like I say, Chinese banks adhere to US regulations. We're going to watch this closely, of course. It's still not clear what China is going to do, but already we've seen elements of it, where Chinese banks stopped buying seaborne Russian oil. Many Chinese banks have stopped financing commodity trade with Russia. Singapore Bank did the same thing. I think that at the end of the day, we're going to see that there is arbitrage opportunity between Russia and China, and that it's our interest to play up this difference between them. It's like using, once again, like Nixon tried, using China to help us battle Russia. And I think that we shouldn't dismiss this. And I think that what's happened recently, I think, is that, of course, Russia and China don't like NATO. We think of it in the US as a defensive force. NATO is in Afghanistan. It's hard to convince the Chinese or Afghanistan's neighbors that NATO is just a defensive force in Afghanistan. So, of course, the enemy of my enemy is my friend. But when it comes to these hardcore issues, will Chinese banks take the risk of being sanctioned? I don't think so. I don't think that there's anybody really using the Russian ruble for trade purposes, unless they have to, or even reserve purposes. And even when it comes to China's currency as a reserve currency, who's the biggest owner? Russia. So I would deflate a lot of Chinese reserve numbers that the IMF publishes. It's a great page to take a look at, COFER, COFER. You can just Google that, IMF COFER data, and it'll give you all kinds of history of the reserve data. But at the end of the day, the Chinese currency is a very small part of reserves. The dollar share is more or less, it fluctuates, of course, but it's more or less the same it's been for 10 or 15 years. I just don't think that, so for me, and again, going back to the trading idea, whether the dollar's a reserve asset or not, I don't think matters too much for what it means for the next day of the dollar, what it means for the next week in the dollar. And in that kind of framework, what I'm looking at is a couple of things. One is, of course, this war, and we've seen this risk off to begin the week that's already fading. But the big thing I think this week are two economic points. One is the Eurozone. They're going to report the February CPI, and it looks like it accelerated. And that'll set the stage for the ECB meeting on March 10th. The other big event this week, well, I should say two other data points. One is China's PMI. And we might talk China, we might think that China is some kind of like huge giant on the world globe. But at the end of the day, the Chinese economy is very weak. In fact, its PMI is likely to fall, its composite PMI, combining manufacturing and services, likely below 0.5, below the sort of the boom bust level. And so, of course, China has low inflation because they have about 1 or 2% growth. The US just posted better than 7% growth. So, of course, we're growing faster. We expect a bit more inflation. But so we've got the Eurozone CPI, we've got the Chinese PMI, and then at the end of the week, we should get another strong US jobs report. Say roughly, I think the median guess is around 400,000, which is not far from, I mean, it's a healthy report, and we might even see unemployment tick down a bit more. And so I think that when people think about this period, who's standing up to Russia? This coalition did not exist in 2008 when Russia invaded Georgia. President Bush was the president at the time. And there wasn't this kind of market reaction either. So I think that the market, everybody knew since February 11th, when the US intelligence said that attack on Ukraine could be any moment. I think the market knew it, but I think the market looked at the past track record. What happens when Russia goes into Georgia? What happens when Russia acts up in Moldova? Has there been a market reaction? What about when it not only attacked, but annexed Crimea? Was there much of a market reaction? No. So you line up the stars. People like me are looking for these patterns, right? So you line up the stars. What happened to the markets in Georgia, Moldova, annexing Crimea? Not much happened. So it seemed to me that the market might have been perfectly rational looking at the odds of what happened. And so big market overreaction on Thursday snaps back. Not because the central banks or because some hidden hand was intervening and manipulating the markets, but because people wanted to buy the dip. We've been taught repeatedly, I think, to buy the dips, whether it's the 200-day moving average or whether it's a 20% sell-off or a 10% sell-off, whatever one's rule is, we've been reinforced to buy the dip. I mean, the S&Ps made their highs at the end of last year or early this year. The NASDAQ made the highs end of last year. I think the market's been perfect. I think the market's response has been very rational to this. Exaggerated in the short run, but perfectly understandable how it gets to that position.
Okay. So, Craig, I know we don't have all night to go through all the nuances of the trade. Oops, sorry, I missed it here. I wanted to show something, which is this chart, dollar share of China-Russia trade settlements. I would say consensus view is yours, Mark. Maybe contrarian is that this rate of change as well as the direction of China-Russia trade settlements is definitely decreasing. And you talk about that in your article, Craig, which we posted on the website for anyone who wants to take a look at and has been really kind of exceedingly well received. Any comments on, and I just, by the way, grabbed that from Twitter while Mark was talking, because I was like, I remember I saw a chart. So this is basically, this was the one. Any comments on Mark's take?
Yeah, look. I think what I'm trying to do is I'm trying to, put pieces together, different, signposts, and say, 1 + 1 + 1 = 10 type work. Where is the world going to be in 18 months out, and try to, trade accordingly. And so what I see, at the risk of, those harmful words, this time is different. What I see now is that I do see a Chinese oil contract. I do see China buying more and more commodities in its own local currency, not only oil, but iron ore, agriculture, and a variety of things. This dynamic certainly wasn't in place pre-first quarter of 2018. So those other instances of Russia, et cetera, were kind of pre that. So that's where, when I start to think about the long game here for China, what they're trying to achieve, what Russia's trying to achieve, and they're trying to weaken the hegemonic power, that's really kind of, what I'm focused on. And so I see a United States government that continues to spend and that more than it brings in, and now a central bank that, and an more of a central bank that is slow to realize or slow to deal with these negative impacts that are coming from inflation. And that's something that I think is going to stick with us. And so for me, with China and Russia partnering, for lack of a better word, with more commodities being priced away from dollars, we start to chip away at this dollar thesis. And I think that the Western media and the West, broadly speaking, ascribes a very close to 0% chance that the dollar will be replaced. And I'm not saying that the dollar is going to be replaced by the RMB. What I'm suggesting is the dollar is already being replaced around the world, particularly for commodities, and is being, seen as a something where the RMB is taking more share and settling in gold. And so what I think what's happening here with Russia, and we're seeing it, I believe, the Central Bank of Russia now today said they're going to resume buying gold. Where people were thinking they have no access to dollars and euros, they're going to be sellers of gold. No, actually, they're going to be buying gold. And so what if we wake up in a world where instead of Russia selling oil at 20 barrels per ounce, they come in and say, now we're selling oil at 50 barrels per ounce. There is a potential then for, global buyers to see the discounted price, buy gold in order to buy oil, send the gold to Russia, and kind of drain physical gold from warehouses. Why is that a big issue? Because U.S. banks have massive short positions, paper short positions against those gold warehouse deliveries. So what I'm surmising here is that this is a big move by the U.S. that was, I suspect, anticipated by Russia. What did Russia do in the lead up to their attacks? They raised interest rates aggressively in order to strengthen the currency as much as they could, ahead of kind of seeing where this would be. If you look back, and I know Luke mentioned this, but in the Felix Sommery book, The Raven of Zurich, basically, a central bank's tightest monetary policy exists the day before the war starts. So they knew that the currency was going to be, devalued. So what I'm suggesting is that they saw this coming, and they were going to react. And look, hopefully it doesn't come to this. I tweeted this out earlier today, but in July of 1941, the U.S. pulled the same move with Japan, where we basically froze their assets on a global basis. And unfortunately, 6 months later, we know where that ended. And hopefully we don't get to that, we don't get to that place. But this is this freezing of Russia's central bank reserves globally is a ratchet up of the environment. And my sense is that the Russian government is prepared for it and will react in a fierce way economically. I'm hopeful that we don't go the military route in a more aggressive way, which I suspect we all are hopeful that that's not what happens. But from an economic point of view, they could do things like nationalize resources domestically. I know BP owns 20% of Rosneft. They said today, we're looking to sell that. Pretty sure they're going to get zero proceeds for that. That's just going to go back to the government. Those are the types of things that the Russian government could do to make it difficult for, Western players within Russia. And so, look, I think there's clearly strain on the ruble right now, but in an environment where they reprice gold for oil and change that ratio, and China comes in and provides a lifeline to Russia, all of a sudden, Russia has its money. The U.S. is in Europe are forced to continue to pay elevated prices for oil and for food, and inflation stays sticky, and citizens in both Europe and the U.S. are not happy with high inflation, and the polling ratings continue to deteriorate. These are challenging and complicated environments, for investors and for society. So for me, I'm long gold, physical gold, and gold miners as the kind of purest reflection. I think some of the gold ETFs are not great expressions of that, because they're, if you read the prospectuses, like, they could be cash settled. And if there's a sizable reset in the gold price, that there could be a problem there. So I'd stay away from GLD. But GDX is probably fine, and some of the big cap miners are fine. and I'm still long kind of hard commodities and, natural gas, liquefied natural gas, some oil plays, rare earth plays, different things that are going to be needed by multiple countries, in a separate way in these separate supply chains. And as far as a broad equity market call, I'm negative, and I'm particularly negative on tech because I see an environment where interest rates are going to stay higher than people realize. Inflation is going to be higher, and the Fed's going to be forced to be aggressive on the tightening, otherwise run the risk that the dollar is going to be sold even more aggressively, or that the long bond is going to be sold more aggressively. So that's the kind of construct my portfolio is set up right now: long gold, long hard assets, and kind of short high multiple tech.
And luckily you have no assets in Russia because it's the Hotel California, not able to get them out. Mark, a little bit on the euro, and thank you for sharing that, Craig, because this is asset allocation and portfolio positioning for the market open this week. We might have some stability going into it, but as I have mentioned for months now, we've had solid selling under the surface. It has been a sold to you market under the surface before the air pocket of risk. So in regards to the euro and their energy situation, Russia supplies 1/3 of EU gas, and 66% of it passes via Ukraine. So it's significant, their dependency on Russia. And of course, aside from the military and humanitarian crisis, what to do about the euro? What are your thoughts on that, Mark?
Yeah, sure. So I think when you think about Ukraine, I think you're right. People think about wheat. They think about the gas going through. And by the way, both on Friday and it looked like earlier today, or Sunday contracts, it looks like Gazprom, the big Russian gas provider, is really like pouring a lot of gas through the Ukrainian pipeline. So it's kind of interesting. They're doing this in the middle of the war. And the other thing too is, there's been partly because of a drought in South America, Brazil, Argentina, Paraguay, that the price of soybeans, their drought is really causing the price of soybeans to go up, which also feeds into soybean oil, and which is, of course, soybeans and corn are both a feed for cattle and livestock. And so what we're going to see is this, you've got a rise in commodities coming from droughts, coming from, during COVID, Malaysia really closed down their palm oil. So we're really seeing is a rise in these edible oils, and Ukraine accounts for about 50% of the world's exports in sunflower oil. And so this is just feeds through the whole, I think, to Craig's point about feeding through the supply chain of food. And partly this is as a consequence, the Ukraine is the sunflower oil element there. So when I look at what this means for the euro, I think, of course, it's like Europe's going to have a higher gas prices. I think that the central bank, the ECB's chief economist, just suggested, just on back of an envelope calculation, that it could shave 0.3 to 0.4% off of their growth this year. So it's not perhaps it's not a crippling impact, but it is a serious blow to the economy as it tries to recover. On the other hand, here's an awkward framing, bookends, if you'd like. The dollar index and the euro, I should say the dollar index bottomed, the euro topped out on January 6, 2000, when our capital was under siege. It seems to me possible that the euro bottomed out and the dollar index topped out on Thursday when Russia invaded Ukraine. And so I'm watching the price action very closely here. We got back down to about 111.20 in the euro, which is just above the lows we saw last week. Gold, last week's high, 1975. We went up to 1930 today, another safe haven look. And and same thing with dollar yen. It's held up much better than it did last week. I think today we dipped down to just below 115, and we're back at about 115 and a half here. So I'm thinking that the euro, the first part of this week, maybe the euro recovers from this slide again. Once again, this 111 area held. I had the possibility of what is it? I think in the dollar index, what we saw last week, 97.70. I think we might have surpassed that. And to me, that was an important technical level. That is the 61.8% retracement of the dollar index's big fall from the March 2020 high. We took it out by a little bit, but we closed back below it. So it took it out on an intraday basis, closed below it on a settlement basis, and I wouldn't be surprised if that's the peak. And so that means that my idea of 110.50 in the euro might not really be met, that we might have stopped shy of that.
I'm actually posting a chart of the dollar, and we have a very, very strong protracted downtrend here in this trend line. This is the COVID freak out, if you will, where that transition to safety was very firmly felt. But we are actually, since this goes back multiple decades, 1990s. This is 1950 that you're just 9750, excuse me, that you were just talking about. So if we were to get and stay above, that would obviously be very bullish. Otherwise, we have been trying and then rejected firmly. So time will tell. It does not necessarily bode well for the headwind up for equities if it does, or if it tanks either. So the dollar matters, and definitely the rate of change determines its severity. Kind of makes the weather, if you will. I've said that before, and the rate of change determines its severity. So right now, this is a level that you're pointing out. I'm also looking at the same thing.
Interesting. So you didn't do the retracement. You just you looked at the trend line.
Just the trend line. Yep, because it's a bigger picture. It's from the 1990s.
Right. So it is interesting that both levels converge around the same thing, somewhere around the 97.50, 70 area.
Correct. Craig, I know that you have an opinion on crypto, and we're getting a few questions about that. Do you have an opinion on crypto's place in all of this? Since I have talked about weak bonds, inflation and commodities. I've had a theme, obviously, for a year and a half of things over paper, which is that transition into just everything we've talked about: commodities, agriculture, metals and mining. So the crypto is front and center right now. It's not serving as an inflation hedge. It's a speculative asset that's obviously not popped up even during this conflict over the weekend, of the past few days. What's your view on a positioning for crypto? Yeah,
well, it's serving as an inflation hedge if you're based in Russia and your currency just depreciated, 40%.
50.
So 50% and maybe more by the time this call is over. So look, I think that Bitcoin, acts as a scarce, potentially neutral reserve type asset. And it's more, in my view, Bitcoin does for people what gold does for countries. And so, look, if you're Ukrainian and you are trying to leave the country for fear of being conscripted in the army or for fear of a Russia attack, you're leaving with nothing, but you're leaving with your Bitcoin and your hard wallet, and you're putting all your wealth on a disk drive or with a passcode that you can go anywhere with. So I think us in the West have a tough time, putting our arms around that as a reason to own Bitcoin. But if you're in Ukraine or Nigeria or in Zimbabwe or in Argentina or in Bolivia or El Salvador or other places where you've had inflationary episodes expropriate your wealth by, irresponsible governments, then this becomes a core holding for you. I think for the recent price action, I would agree, Bitcoin has been acting more like a risk asset than, a currency that expresses scarcity. And clearly there's been, some, I suspect, that have had Bitcoin versus gold trades on, which are unwound. And so gold's been massively outperforming Bitcoin through this heightened geopolitical regime. So I also think that gold benefits from central bank buying, right? And so we know China's buying gold, we know Russia's been buying gold, and both those governments, I suspect, believe that gold is going to be an integral part of whatever future currency system we have. So being on the side of those central banks and, not fighting the central banks probably is a smart thing. And so gold is, has been doing great. But I think if you're thinking about scarcity value and you're thinking about being able to move your wealth in relatively quick period of time, and storing wealth over time, I think Bitcoin will transition into an asset that is priced off of scarcity as opposed to being more of a speculative kind of growth asset. And so I think the market cap for Bitcoin now is, sub $1 trillion in a world where sovereign bonds still negatively yielding, are in the tens of, close to hundreds of trillions of dollars. So I suspect over time, and you can think about Russia, to the extent that you can get rubles and move them into Bitcoin, or you were able to do that last week, that was a great move for you as a citizen. So yes, countries are going to be loath to see their domestic fiat currency being transacted into Bitcoin, and will, in certain ways prevent the rails from being used. But then there's other countries that are going to continue to embrace it. And so, the question I think will be, how does the US deal with Bitcoin, as a potential offset to this, what I describe as a shift away from US dollars. Maybe the US will embrace Bitcoin. Maybe they'll use Bitcoin on our own balance sheet in order to harden our currency, as people start to worry, about the government spending and money printing and the like. So for me, I'm a Bitcoin bull. I'm not a Bitcoin only, because I do own some gold too, but I don't own really any other cryptocurrencies. But I do think Bitcoin is an asset, and particularly when you think about what's going on in Canada with the trucker protests, or you think about what's going on with, potentially, I think I saw a headline that if you donate money to the Ukraine, then, Russia will come find. I mean, so there's an element of kind of being able to use crypto money for other purposes when you don't want the government to be kind of seeing what you're doing, and that look, I mean, hopefully we never get into a situation where we're kind of forced to leave the U.S., but in an environment where things happen, being able to leave with your wealth and go anywhere in the world with it, I think is a fairly valuable tool. And eventually countries will likely compete for talent, in a crypto Bitcoin friendly way. So that's more of a kind of 3 to 5 year thesis. But, for now, yeah, I think you can say maybe it hasn't been performing as expected, but if you're in one of these countries with a massively devaluing currency, it's been performing exactly as expected.
Well, let's hope it doesn't rise based on the devaluation of the dollar. So speaking of intervention, though, and its potential for cryptocurrency intervention by governments, and specifically the US, and regulation and the rest, we have the same risk right now with oil. Oil has obviously spiked very strongly, and it was a theme of mine that it would, from a year and a half, that oil would serve as an inflation hedge. And I did have, which I do not want to see, but 130 for oil for March of this year. And then I also kind of pivoted and said, but oil as a public utility. So originally it was oil as an inflation hedge. Inflation was definitely going to stay sticky post-COVID and supply chain stress. And then this public utility feature, even before the invasion, has now really got my attention, because that risk of intervention for price fixing or export ban makes it really tough to trade oil. Long story short, it's a lot easier to trade the proxies of the ETFs and the oil and gas companies than the underlying, simply because of the risk of intervention. So, Bitcoin has the potential of it, but then so does oil. So it's treacherous now.
I think, there's, as countries, like I said earlier, I think countries are going to, give heightened, relevance towards procuring domestic, their own energy sources in whatever kind of means that they can. And it, you have a situation where the U.S. is, the U.S. actually is importing Russian oil to the tune of 600,000 barrels a day, which is crazy, but given the state of the world. But we do export a fair bit of oil too, different grades. And so, are we going to get into a situation where we put an export ban on oil in order to keep domestic prices from materially moving higher? I mean, I think you saw this a little bit last week with some of the exemptions to the SWIFT sanctions by various countries who are seeking to provide for their own domestic economies. I think this sense of deglobalization where countries look to protect their own citizens first and keep their own inflation at bay, or they keep their own economies growing more robustly, will take precedence over helping out the rest of the world or helping out, democracy in Ukraine. So I suspect that's a theme that is going to stick with us for a while. And I think we're going to be in a situation where we have more export restrictions for all commodities, but particularly oil and energy kind of going forward. And so the US in that case is, stands to benefit, right? We're a surplus natural gas country. We export natural gas. From an oil perspective, we've been an importer, but we've been an exporter too. We have a much more balanced situation there where we export coal. We have a robust agriculture system where we're a net exporter of food. So in a lot of ways, the US stands to benefit. And I think from a dollar's perspective versus other emerging market currencies, or maybe the euro or the yen, I see the dollar doing okay. I'm just pointing out that, versus commodity prices, the dollar has been devaluing pretty aggressively, and versus real assets, the dollar has been, devaluing aggressively. And I suspect that's something that, will continue.
But not all at once. So this has been very helpful, I hope, for those who've attended or watched the replay, just in getting consensus, non-consensus view about the dollar, short-term, long-term. I really appreciate, Mark, your take that it's going to strengthen in light of world events. And I also appreciate Craig's, perspective of the fear that we could be losing ground, and it will happen slowly, then, potentially faster. It's something that I don't trade on that 3 to 5 year time frame, but I'm looking at what risks come up, obviously for clients trading across multiple time frames. But for right now, it's a lot of volatility in the space, especially around currency. I just saw that there are some nations that are coming to the aid of the Russian ruble, Cuba, Venezuela, the usual suspects, North Korea, basically. We definitely have risk as it relates to military and humanitarian. I wanted to just kind of touch base a little bit about the dollar status, because everything rotates around it right now, not just contracts. And the size of our banking system is what, 11, 12 trillion in US dollars, but the trading that's going to take place this week, and it is on a much smaller time frame. And I'll be addressing that tomorrow. I'm going to be running my live trading room just like I did last Thursday. Obviously, futures are not plummeting, which is wonderful. There'll be more opportunities for those who want to de-risk. In the meantime, we will decide, the market participants will decide how much de-risking and de-rating they have done in equities. I am going to be watching for sure the bond market. And Craig, I know you're very focused on the credit markets. And Mark, I know you're very focused on the currency markets. So I appreciate this kind of collective view and maybe a few charts, but the idea was not to be so micro today. I'll be doing that. That's why I do my live trading room. And again, just to kind of reintroduce, if you will, where to find these gentlemen for those who want to follow on Twitter. It's great handle. It's Mark Making Sense, M-A-R-C, Making Sense. Let me just bring this up real quick. You can see this over here, hopefully, with a little screen share. Yay. All right. And again, he has a book and a full-time gig and lots of, international media gigs in sizing up multiple assets, but specifically the currency markets. Appreciate that balanced view. He also does a fabulous daily. You can sign up for that. He has I'm sure I'm missing one or two because he's just prolific in his writing, but I really want to highlight his excellent, the daily grind of putting out really consistent content. It's fabulous. And I really want to highlight that because I look at it every single day to see if there's anything big under the surface, like some of these option trades that you point out. I happen to find that very useful. So thank you for your take. And also, again, where to find him on online. Craig, I have mentioned, is a former client for a few years and has recently joined me so that we can offer some custom, very personalized service for our institutional clients, because we kind of at LaDucTrading bridge the gap between retail and institutional. So this is very much a focus on helping to do what he just did, which is kind of size up that macro and then put together actual trade ideas. So if you have interest in popping in tomorrow for the live trading room, I will be putting out a link on my Twitter page, and then you can kind of just come on in and check that out if that's of interest. Otherwise, you know where to find me, LaDucTrading.com. Samantha LaDuc, Marc Chandler, Craig Shapiro. I am very grateful again for this exchange, fireside chat on a Sunday evening, where hopefully the world will be a little calm and we can get through the trading week. And we put our hearts out there also for what's going on in the European stage. And that has been all consuming this weekend. So let's get back to markets. Thank you so much for attending, everyone, and hopefully that you have a peaceful night.
Thank you very much.
Thank you.
Good luck, everybody.
Thank you very
Same.
much. Bye-bye.